Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Thinkorswim. And today, my mind was kind of going to next year. It's November. We're starting to move toward the end of the year. Lots of traders and investors might be turning their attention to what might the next year bring. Well, today I wanted to talk through 5 tools on Thinkorswim charts that might assist with a trader or an investor establishing for themselves a year ahead outlook. I think that's a great topic for discussion. I think a lot of these are going to carry some interesting insights for a number of you. Before we get to any of those tools, though, let me first of all say hello to everybody who's already chatting in out there in YouTube and our live audience. Great to see Greg and Ro, Jim, Ted, David, Roger, Rasu, Richard, Chris, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions here in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy that presentation. The recordings are a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Wednesday webcast series, and we kick things off promptly at 2 Eastern time. We'd love to have you here in our audience. And I also want to let our live stream audience members know that my very good friend Mike Fairborn is going to be hanging out in the chats. He's going to be keeping an eye on that chat window on YouTube to see any questions that might come in that I don't have a chance to address myself during a live natural flow of the presentation. Mike's there to pick up my slack, so thanks for having my back there, Mike. And Mike and I would also like to issue an invitation to everybody listening. You should be following your favorite Schwab presenters on social media. You can find Mike on X, at Mike Fairborn CS is his handle there. You can find me on X, at Cameron May CS. Now, you can also find me now on LinkedIn. If you go to linkedin.com/in, and then you throw on a /Cameron May CS, that'll take you right to my profile. Give me a follow there. Anyway, if you reply to one of my posts in social media, I try to just reply right back to you, and allows for some nice interaction when the camera's off. But let's get into this discussion. And of course, what we're going to be discussing carries risk. Trading carries risk. Investing carries risk. So bear these important disclosures in mind. All corporate or issuer names and market data shown are for illustrative purposes only and are not a recommendation, offer to sell, or a solicitation of an offer to buy any security. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's lay out an agenda for what we're going to be talking through today. 2026 is right around the corner. I think there are going to be plenty of traders and investors out there trying to gear up for 2026, establish for themselves how they suspect that year might go. Nobody has a perfect insight into how it might go. But I'm going to be sharing with us 5 chart tools that are available right there on the Thinkorswim desktop platform that may assist with getting some context. All right. So I'll walk through each of those tools using real-time examples, talk through how a trader might use those in their preparations, and we'll make sure that we go at a pace and everybody can follow. Okay. So let's go right to the Thinkorswim desktop platform. And I'm going to be using, to start things off, the S&P 500. So you can see here we are in November. It's November 19th. Right out here is that hashed line representing the transition to 2026. That's the end of 2025. And so let's put ourselves in the shoes of those traders or those investors that are trying to gauge what 2026 might hold in store, right? Now, one initial step, so this is going to be tool number 1. For some traders, they may just observe, well, what is the current trend of the markets? And maybe those trends will persist in the end of the year and maybe moving into the next year. Maybe we'll recruit another tool that might assist with identifying when those trends have shifted. But for some traders, they may just look at price action, but price action can be quite jittery. Red one day, white the next. Red one day, white the next. Gap up, gap down. To smooth out some of that day-to-day noise, a very common indicator, as a matter of fact, in my experience, the most commonly used indicator on a stock chart is known as a simple moving average. And it's intended, among other things, to identify potential trends. So let's add tool number 1. Let's go up to our Edit Studies flat. I am for simple moving average, and we're going to add that to our chart. Now, the default moving average is just going to look back over the last 9 days and give us a trend based on that data. Let's extend that out to a longer period. How about for this example? We could go for a relatively shorter time frame or relatively, well, a longer time frame. Let's go for maybe the last 100 trading days. That's looking back about 5 months, 4.5 or 5 months. Let's click OK and click Apply. And what you see we're left with here is this green undulating line that's running through price action. And it's intended, it's commonly used by traders. Its intended use commonly is to identify what is the real trend, because we might look at price action recently and see that it's been coming down. But does that mean this is the beginning of the end? Does it mean that the trend is already reversed? Well, according to those who use this approach to trend analysis, they might just look at that moving average and look to see, is it still upward sloping? So if you're not entirely familiar with a simple moving average, it just looks at the selected time frame. So we just chose 100, which on a daily chart means the last 100 days, and it plots the average closing value for the charted symbol, in this case, the S&P 500. What we could say about this number over here to the right, 65.4116, is that's the average closing value for the S&P 500 over the last 100 days. And over time, that average value changes. So if we were to look back in June, when average prices were lower, you can see that in this moving average line. So as average prices change over time, you'll see this line move. Now, for other traders, they might use this as potential price floors and price ceilings. But let's just say that's tool number one for the identification of current trend. And for those that subscribe to the school of thought that once a trend is established, it's more likely to persist than not, then this could be an important tool. So let's move on to tool number two, and that is, how might we recognize when a trend has significantly shifted? Now, there are a number of ways that we might do that. We might look to see, has price fallen below a trend line? Has the trend line itself reversed? Or for others, they'll actually use the relationship of two trend lines to try to address that question. So tool number two is actually a further customization of tool number one. We're going to change to a longer term view. That's going to be step number one. Let's switch this to a 3-year weekly chart instead of looking at daily candles. So we're slowing down our indicator as a result, but we're going to change the indicator itself. Let's change our 100 period moving average. I'm going to slow this down to just 10. Now, in this case, since we moved to a weekly chart, this would be a 10-week moving average. That's relatively more aggressive, though, shorter term. Let's change this to let's say, sort of a hotter color to identify to indicate that. And let's click OK. But as I mentioned before, for some traders to look for trend shifts, they'll use a combination of moving averages. So let's add a second simple moving average of a different length. We already have the 10. Let's make this second one a 40. And I'm going to leave that green, a somewhat cooler, calmer color than red, indicating it's going to be a little bit longer term. But you know what? Just one other thing I want to do here. Let's change its width to a 3 out of 5 instead of just a 1 out of 5, because for some, they can't really see the difference between green and red. So we'll give it a physical difference in appearance. So the thick green line is now looking at average closing values over the last 40 weeks. And the thinner red line is looking at average closing values over the last 10 weeks. So really what we have here is sort of a long-term moving average and an intermediate-term moving average, identifying trends over those time frames. And for some traders, when they look at that intermediate trend, if the intermediate trend has been strong enough that its trend line is rising and remaining above the longer term, that may just conclude for them or lead them to the conclusion that a bullish trend is still intact. And they might change that outlook if the intermediate falls down through that longer term. So important events here when using this combination of tools is when we get crossovers. We get a crossover right back here a few years ago. We have a couple of crossovers right here and right here, and I want to talk about the names given to those. They're dramatic names. What do we call these, guys? A lot of you know what a 10 weekly moving average crossing above a 40 weekly moving average implies, and you know its title. Yeah, this carries the rather dramatic sounding name, a golden cross. Ooh, that sounds like a promise. It's not a promise. Nope. Trends don't have to continue moving higher just because we've had a golden cross. But what it implies for the technical trader is that the intermediate trend has strengthened sufficiently enough that it has caught up with the longer term trend and is now surpassing it. And that might be enough to influence that longer trend. And for this technical trader, they might look to this to be a signal of emerging bullishness. And then Zach says, yeah, when we get a crossover in the opposite direction, this carries an even more dramatic name. This is known as a death cross. So it might imply that there is significant weakness in the intermediate trend. It's now falling through the longer term, and maybe things are going to go down for work out, though. In this case, we got the crossover right here, death cross. Oh no, buyer beware, all that stuff, right? Actually, stocks only went down for another few days. These are weekly candles. So we're looking at the close of one week to the close of the next week was actually up. So this might be considered kind of a failed or a whipsaw death cross. And then we got a golden cross that might have just gotten the trader back on the right track, at least for how things have played out to the present day. So bottom lining all of this, with the intermediate above the longer term, having recently had a golden cross, the trader might be looking at this and saying, well, as long as that's still the situation at the end of 2025, moving into 2026, they may have a bullish outlook, if that's their particular lens. Okay, so those are two tools. We have using moving averages individually. We also have using moving averages in combination. I'm going to switch things up significantly here, though. We're going to shift gears. Let me go back to a 1-year chart and remove these two tools. And I'm even going to change from the S&P 500 to the Russell. What is the difference between the companies in the S&P 500 and the companies primarily making up the Russell? Russell is comprised of about 2,000 companies. They're smaller typically. The S&P 500 has 500 larger companies. And for some traders, as they're trying to gauge how things are going, and maybe they're trying to get an insight into how much of an appetite for risk traders and investors might have, they might look at the relationship between the small capitalization stocks of the Russell and the large capitalization stocks of the S&P 500. And when there's a lot of enthusiasm for the small caps, it might mean that traders are willing and investors willing to take more risk. Maybe if there's a move of money to the Russell, there might be a larger risk appetite, maybe reflecting stronger positive feelings or sentiments toward the economy. If we see, however, the flow of money moving more toward the S&P 500, the large capitalization stocks, those that for some they might consider to be safer, safety, falls on a scale, and nothing's truly safe if it carries the potential for reward, right? But flow of money back and forth, a relative strength between small caps and large caps may be interesting for some traders to keep an eye on as we make important transitions, like ending 1 year and moving on to the next. So let's go to the Russell. And I'm going to add a third tool here. So the chart symbol for the Russell 2000 is RUT. I'm going to go up to our edit studies, and I'm going to use the relative strength tool to explore the relationship between large caps and small caps. How many of you are familiar with the relative strength tool? Go ahead and chat that in if you are. But it's not going to be relative strength index. This is just plain old relative strength. Those two sound very, very similar. I get lots of questions about this one's a relative range. Anyway, you know what I'm talking about. Relative strength, RSI. The RSI is very different from just plain old relative strength. So let's make sure that we're choosing relative strength. Let's add that to our chart and click apply. And as we click OK, what we'll notice here is that we have two lines. We have one that's a perfectly flat line, and then we have one that's a blue line. Both of these start right at the beginning of whatever chart we're viewing. So you'll notice they converge right here at the start of our chart. So this red line is just a benchmark. This is showing us at a glance, if our blue line is below the red, it's telling us that specifically our charted symbol, in this case the Russell, has been underperforming the S&P 500. So we're comparing which one has been relatively stronger. Whatever we have up here on our chart, or the S&P 500 as a benchmark. So if we see the blue line below the red, it means that since the start of the year, our charted symbol here, the Russell or small caps by extrapolation, small capitalization stocks seem like they've been underperforming the large caps represented by the S&P 500. So another function of the blue line is to show that performance over time, not just one point of comparison, today versus the start of the year. But this is just how the Russell is performing relative to the S&P 500 from day to day. And you'll notice there are times when the Russell's going up, and yet its performance against the S&P 500 is flat or even potentially down. What that can reveal to the trader is that there can be times when small caps look like they're doing well, but they're not doing as well as the large caps. That's how we might interpret the Russell going up, but the relative strength going down. Okay. Eric Goldberg said, would the comparison study, and I think what you're talking about now is the correlation study, reveal the same thing? Or could we just put them both on the same chart and just study them out that way? Yes, there are different ways that we might do this. But for traders, there are specific behaviors they might look to on a chart that might give some insight between important flows of money. It's a typical interpretation. It's not a perfect insight into things, but when they see, for example, the relative strength of the Russell going down, well, I don't want to draw an oval. Let's remove that. And let's get our trend line tool. But when they see that going down, if we were to hide this chart and all we were doing is looking at the relative strength indicator, all that this would tell us is, hey, right now, the Russell is weaker than the S&P 500. That might mean that it's going down and the S&P is going up. It might mean that it's going down and the S&P is also going down, but the S&P is not going down as rapidly. That would still mean the Russell is weaker. It might also mean that the Russell is going up, but the S&P is going up faster. That's also weakness, relative weakness. But in any case, and all of those things, they're a little bit harder to spot when using variations of the relative strength theme. So for some traders, they prefer to just see this blue line. And they can just state, okay, during this period, the Russell is weaker than the S&P 500. Now, when it starts to break those trend lines, though, that can be, to some traders, an important new development in that relationship between small caps and large caps. This might signal that small caps are starting to outperform and may start to steal some of the limelight from the large caps. And so when we broke this downward slope, it means that small caps no longer underperforming large. During this period, they were actually keeping pace with the large caps. And what does it mean here? What's going on here? Small caps are actually outstripping the performance of large caps. That's what that means. Yes, they're going up. The S&P was probably going up at the same time, just not as quickly. Now, here's another recent trend line break. So the S&P has come down, the Russell has come down even faster. So for some traders, they like to look at that at a break of trend lines. So let's take that and apply that to a longer term view. This might provide a different perspective. Let's clear up this drawing set and switch this now to a 3-year chart. What's been going on with the small caps pretty much all of the last 3 years? If we have a portfolio constructed primarily of small capitalization companies, it has not done well. Yes, it's been done well, okay. I mean, relative to itself, there's been growth, but there may have been stronger growth in the larger capitalization companies. And a trader who is looking at this now, they might be waiting for this to happen, a crossover, a change in this longer term trend that may signal, oh, maybe it's time to start moving a portion of my portfolio from large caps, or maybe they've had a preponderance and move that, reallocate toward the smaller caps. Hasn't happened yet. That's interesting. Yeah, relatively stronger, relatively weaker is a great way to say that, Eva. Yep. Remove these two drawings. So that's sort of tool number 3 as we're looking at 2026. What we might be able to say is, okay, it looks like the S&P has been going up. It's still strong, and actually relative to smaller caps, that's been outperforming. So we'll see if there's a change to that anytime soon, but that's sort of the condition right now. Now, for some traders, they like to go another level deeper, not just looking at large caps versus small caps, but what about the individual sectors that may be driving or lagging the S&P 500 performance? Let's have a look at that. So I'm going to use this relative strength again, but I'm going to switch this up. Let's go back to the 1-year chart. And I'm going to come over here to the watch list in the left column. And one of those watch lists that's maintained and published by Thinkorswim, if we go to the public watch list, we can choose something called, oops, it's hopping around on me a little bit there, the S&P 500 sector indices. Really what this does is it loads up the 11 sectors that make up the S&P 500. And we can see those sectors here: energy, materials, industrials. If you don't have the description as a column heading here, you can add that right here. Go to customize and find description right there and just add that, okay? But I can see energy, materials, industrials, right on down to real estate. And the relationships of these 11 sectors may actually give traders, they're actually models built around the relationships of these sectors to hopefully provide insight into how the economy itself is doing. So I have a question for you. Think about the traditional economic cycle, if you have any experience with that. Tends to rise and to fall. And to rise, the economy sometimes is strong, sometimes it's weak. And when the economy is strong, some sectors tend to do better than others. And as a matter of fact, the performance of those sectors may actually provide some insight into how the economy is doing if we can't otherwise read or get a gauge, get our fingers on the pulse of the economy. Not always perfect, but the rising and the falling of this economic cycle, historically, it's tended on average to last somewhere between, from a low in the economy to another low in the economy, or from a peak in the economy to another peak in the economy. These cycles tend to last somewhere between 6 and 10 years, 8 years on average, although in recent decades, that seems to have stretched on a little bit longer, okay? But let's use our sectors here to see where we might be in the economic cycle. Where do you suspect we are? Anybody want to venture a guess? Expansion or contraction? Are we early, mid, or late in those phases? So here's what might be interesting. I'm going to switch this out to a longer term chart, because if a cycle tends to last on average about 8 years, then looking at a 1-year chart might be it might be zoomed in a little bit too close. Let's look at least half the length of one of those cycles. So that would be from low to high, or possibly from high to low. I'm going to switch this to let's go to a 4-year weekly chart and click OK. Now I'm going to leave our benchmark against the S&P 500 down here, because let's just skip to the front. I'm going to click on information technology. Oh, and Eva says maybe early contraction, maybe. Let's see. All right. So here's what's been happening with information technology. If we just look at a chart of technology stocks, on average, they've been having a great run. And as a matter of fact, compared to the S&P 500, so this is what our indicator is now showing us. We're looking at the technology sector. That's our charted symbol, against the S&P 500, which has been relatively stronger over the last 4 years. So it's not just that technology has been up, it's actually been even stronger than the S&P, which is sort of a broader basket of stocks, right? So it's really been leading the charge. And that's quite typical of early to mid economic expansion, at least according to traditional models. Now, if we think about this, if technology tends to do well during periods of expansion, and periods of expansion tend to last on average about 3 to 5 years, how long have we been expanding? We're closing in on the end of year 3. That could be interesting for those that use those sort of models to try to gauge where they think the economy might be. What this might mean is that we're kind of possibly moving toward late expansion, if there's other evidence here in the different sectors. And I would actually make a case that I think that evidence is there. I'm not perfect. I don't know for sure. But yeah, IT has had a very strong run for several years. Now, doesn't mean that we're absolutely at a peak. And what a trader using the relative strength might look for here is, when does information technology and other early to mid expansion sectors, when do they start to struggle relative to everybody else? That hasn't happened just yet, at least according to this longer term chart. If anything, technology has accelerated its pace of expansion relative to everyone else. Okay. Now, another one of those sectors in those economic models that tend to indicate expansion is communications. What's been going on with communications? It's also had a great run, and that run still seems to continue. Now, if that trend line were to break, if communications and technology were to start to struggle on that longer term perspective against the other components of the S&P 500, that may signal that we've, can I say officially? Probably not, but it may be more likely that we've hit the late expansion moving into early contraction phase. Okay. Now, as for the rest, there are others. They're sort of the other sectors that some might be keeping an eye on are those that are indicative of having more confidently achieved an early expansion, a late contraction scenario. And that might be utilities, it might be energy, it might be healthcare. Yep. So let's have a look at those in just a moment. But before we do, I want to first of all say thank you, Eva. Thanks for pointing out there's a survey. Everybody, there's a survey in the chat window. So if you do me this favor, click on that survey link and then fill that survey out when the webcast is over, and you can give me some honest feedback. That would definitely be appreciated. It's a really short survey, 2 multiple choice questions. There's a comments box and a suggestion box. And if you want to fill those out, I read that stuff. It's never a wasted effort, and it always helps. All right. So thank you for the heads up there, Eva. And thank you, everybody, for filling out that survey. But we've looked at sort of the traditional or typical growth sectors. Let's look at some of those that are more indicative of contraction. Now, I want to throw one thing out there. If let's say technology and communications start to struggle, does that mean that the economy has now moved into contraction phase? No, actually, just so you know, there tends to be a bit of a lag there. Generally 6 to 12 months, where stocks will tend to behave as though the economy has moved into contraction before it's actually begun contraction. So stocks tend to lead. That's a tendency. It's not a guarantee. All right. But let's go have a look at what's going on with, let's see, which one did I take a look at? Oh, yeah. I'll leave energy for the end because utilities and healthcare. Actually, no, it's utilities. Let's look at energy. Energy, how's it doing? Well, you can see stocks just haven't done very well. Energy stocks, not a terribly good last several years. And that's reflected in relatively weak performance against the S&P 500, against the other sectors in the S&P 500, or just the S&P 500 more broadly, still looking weak. So expansion stocks still looking strong. Contraction stocks still looking weak. That seems to be making more of a case that we're still in expansion, right? Time will tell. Stock can turn on a dime. Who knows? But let's see what's going on with healthcare. Healthcare, On just the stock chart, looking fairly strong, we can see a little bit of a blip upward, but still not enough to reverse longer term trends. Still appears to be weak. What about utilities, though? These are all what we traditionally call defensive sectors. That means when traders and investors are feeling pretty skittish about the markets and they want to move away from maybe speculative positions and move toward safer positions. Safer, I always hesitate to use those sorts of terms, but I think you get the point. Getting defensive, getting into things that people just always need. We always need energy. We always need utilities. Got to keep the lights on. We always need things like staples in healthcare. But in any case, utilities have actually, you know what, had a pretty good run over the last 18 months. There's some possible early sign of some rotation, maybe dragging us more toward that late stage of expansion. There's some emerging strength here, maybe especially if we can get a breakout here in the near term. And while we're at it, let's look at staples. Staples still weak, actually even weakening further. So this is another tool that some traders might use to get a gauge when they're approaching the end of the year. Maybe they've been bullish all year and they're wondering, well, shall I continue being bullish or make some changes? These might provide some context. So that's tool number 4, using the sectors and looking at relative strength on a longer term view. Now, the final tool that we're going to use should be familiar to a lot of my viewers of my webcast series on a regular basis, because we use this one fairly commonly. It's the seasonality chart. And this is the chart that a trader might use or an investor might use when they've looked at the other things and they've come to their own conclusions, but they just want to see if their conclusions line up with the way things have happened historically. So let's hide this left column. Let's remove the relative strength for now. Let's switch this back to a 1-year daily chart. And I'm just going to go right back to the S&P 500. So let's say that our trader has done all that work. Let's clear this drawing set just to have a nice clean chart. And they think, okay, well, it looks like we're still above our 100 period moving average. It looks like there's no near-term death cross. It looks like we're still in an apparent expansionary phase according to the traditional economic cycle methods. There's still maybe a tendency toward a large cap than small cap. All right. Well, how have things behaved historically? We can do this with individual indexes. We can do it with stocks. But what I want to look to is, how has the S&P 500 performed over the course of a typical year? And we can get a 20-year window into that by changing up the style of our chart. So I'm going to go to style. Let's change this from just a standard chart to a seasonality chart. So if you haven't seen the seasonality chart before, we have a green line and a red line. The green line is how we've done year to date. So this is really just the S&P performance. So we've already seen that. We know that it's been a pretty good year. We run left to right upward. Down at the bottom, though, this is showing us by default how we did last year. And we could do a comparison. Looks like last year, for example, we started a run, I don't know, mid-May here or mid-April and started to go higher for the rest of the year. It's kind of been the pattern this year, even more pronounced. That's only 1 year compared to 1 year. Let's look at the last 20 years. What has the S&P done, and what have been any seasonal tendencies over the last 20 years? All right, so I'm going to come up here to our daily chart. Let's change this to a 20-year weekly chart. And this little line down here now is showing us the average performance over of the S&P 500 over a 20-year period in a typical year is the way to think about that. And I just want to zoom in on that. So let's come up here and click on our right expansion. It's not our right expansion settings. It's our Y axis. And I'm going to change that from just being automatically established. Let's do this manually. And that'll allow me to come down here and zoom in from top to bottom on that average chart. So let's zoom in on that. And so what we're left with now is just this red line. And this red line is a summation. It's the average performance of the S&P 500 starting on a typical January 1st moving all the way to the end of a typical December 31st, day by day, what has the S&P done on average on each day? And so JDLMI says, can you show again how to get the seasonal chart? Yep, so it's a chart style. So the default chart style is just going to be standard. So I just switched that to seasonality. Okay. Now, another thing you can do is you can watch the recording of this session. Go back and see how we do these things. So this is one of those that's scheduled to be added to our archives. But here we find ourselves November 19th. Let's go to November 19th on the average chart. That's about right here. How is the average year finished over the last 20 years? On average, prices have gone up. How has the average year started? So just imagine we're looking into a future look of 2026. We're not doing that. This is historical data. It's not a guarantee of how 2026 is going to go. But on average, the first month and a half has been a pretty good run in a typical year. Not if we're looking from the middle of December to the middle of April, or even toward the end of April. But then we start to climb again. In early summer, there tends to be an increase in price. But if you look really through the bulk of summer, this is probably the least productive time of the year. That's interesting. And getting that sort of a context may actually, for some traders, depending on their own personal feelings, maybe the tools that they've used could be the tools that I just introduced, might be their own personal set of tools, but they might just sort of overlap this with their own outlook, and it may help them make more refinements to their intended approach to their portfolio. Right. So, for example, if everything was saying, "Hey, let's get all geared up and bullish," and yet we're at the end of July, that doesn't really align with the way things have typically gone July into November. If we're about to get bearish, just as we're moving into holiday seasons, we might be fighting against historical trends. Maybe we're right. It's always that possibility, but it could be the probabilities are not there. Okay. But guys, we've done it. There are 5 tools that a trader might use as they're trying to compile their own outlook for the coming year. In this case, it's going to be for 2026. These same tools are, unless something weird happens, still going to be available for 2027. So I hope you found this to be helpful. I always enjoy doing these webcasts. I want to go back to the question that said, hey, how did we load this up again? That's a good reminder that the vast majority of our webcasts are quickly posted to our YouTube channel. So do yourself a favor. And if you haven't subscribed to our Trader Talks Schwab Coaching webcast channel on YouTube yet, do that right now. You can go down and click on the subscribe button. It only takes a second. It doesn't cost anything. But this is where we house our playlists from our YouTube series. You can also join the live streams right here. But for example, if I wanted to find the playlists for getting started with Thinkorswim, I could just click on playlists and scroll all the way to the bottom. Mine just has to be last, right down there. Getting started with Thinkorswim, we can click on view full playlist, and there's last week's discussion. Coach Cam's top 5 Thinkorswim tools for stock traders. Now, another thing that you can do, another way to access your favorite presenters, is to make sure that you're following us on social media. So you can follow Mike and me on X. Let me bring that up here. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. But if you reply to one of my posts, I try to reply right back to you. So for example, I had a question about NVIDIA's earnings, which are happening today. It's not a recommendation of NVIDIA, but I just wanted to see what people think is likely to happen with the earnings announcement. Is there going to be a big price jump, a big price drop, a big nothing burger? And when you reply to me, I just try to reply right back to you. It's interesting to have those sorts of communications with each other. But there's also this reminder right here. I just added this on October 21st. That's because starting just within this last month, you can now also follow and interact with me on LinkedIn. So for LinkedIn, you'll go to linkedin.com/n. That's just sort of the generic URL prefix. then throw on a slash Cameron May CS, and that'll take you right to my here to my profile, and you can give me a follow. All right. So if you follow me on LinkedIn or X or both, if you reply to me on those platforms, I try to reply right back to you. I always say, unless you say something that's too hot for me to handle, I know how to get myself in trouble. I also know how to avoid that trouble. If you're trying to drag me into it, I just steer clear. Other than that, though, we're having a good, friendly conversation. Yep, that's where you get interaction with me. So follow me on X, follow me on LinkedIn, follow Mike on X as well. But guys, thanks for giving me your time today. I can see a little bit over 100 people watching the live stream right now. It looks like, as I refresh my screen, 42 people have already clicked the thumbs up. I definitely appreciate that. That helps. It gives us a nice pat on the back. It also gives us a boost in the YouTube algorithm so more people can find these webcasts and they can learn about things like the sorts of tools that are available on Thinkorswim charts for preparing for the next year's outlook. So hope this was helpful for you. Mike, thanks for helping out there in chat. Definitely appreciate it. Everybody, go fill out that survey if you would, and I'll be reading through those survey comments and that data as soon as I get it. But I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.